Now, energy was the biggest decliner in the S&P after a government report showed U.S. oil supplies were higher than forecast last week, and crude prices fell to an 8-month low. West Texas Intermediate fell 1% to $91.67 a barrel. Brent crude also down 1% to $98 and change. Bob Pisani takes a look at the reasons behind the drop in oil prices and what's next for the energy sector.
Oil dropped to an 8-month low today. That is great news for consumers, and it's a big help for an improving economy. Now, you'd think with all this chaos in the Middle East, oil prices would be skyrocketing, but the opposite is happening. That's because despite the chaos, the demand for oil is weak. Because with the exception of the U.S., the global economy is not doing that well. And there's plentiful supplies of oil because the U.S. has become a big additional supplier. So we have lower demand and plentiful supply. Little wonder that energy stocks are lagging the stock market. The major energy ETF, the XLE, is sitting at a 4-month low. And stocks like Exxon and Chevron have been a major drag on the Dow in the month of August. Other big global energy stocks like Total, Petrobras, and PetroChina were also down today, and they've been weak for days. There's a larger problem for energy. There's not a lot of visibility on demand growth. So if you can project how much economic growth there will be in the world, if you have some certainty in what you think the global GDP will be, for example, you can create a model that will project demand for oil. But without a clear viewpoint on global growth, you're lost trying to figure out what the price of oil should be. The president is speaking tonight on what he will do about the ISIS threat in Iraq and Syria. What traders want to hear is that the president will find a way to get this problem under control. It will mean more certainty for the global economy, and stability is what everybody wants right now. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Well, as Bob just reported, President Obama will address the nation at 9 o'clock Eastern time tonight. The president is expected to outline a broad strategy to defeat Islamic militants in the Middle East. How will that strategy play out in the markets, and how will investors react? Joining us now, Mike Holland. He's chairman of his own money firm, Holland & Company. Hi, Mike. So, complicated situation here. What do you think the president is going to say? Will it have a market reaction tomorrow, especially as we're coming close, and tomorrow is the anniversary of 9/11?
Well, Susie, as Bob Pisani just reported, the market actually is coming into this with a preview of its thoughts about that question, and that is that there will be no surprises. We unfortunately have begun to get used to the terrorist threat overhanging us. As you said, it was a bunch of years ago, 9/11. It was in New York that day. That was our wake-up call. We're living with it. It's now getting worse, and we presume it's going to be with us for a long time. He's going to tell us that tonight. I think a lot of what he's going to say has already been thought about by the markets. The stock market is not political. It was up a little bit today. I think that the stock market actually, Susie, is more worried about what's going on with Mr. Putin and Eastern Europe, and actually on a shorter-term basis, what's going on in the UK and Scotland. They are coming up for a separation vote in just several days, and that was actually something that scared the market a little bit today when it looked as if there was a possibility that they would vote to separate from the UK. That would be disruptive, but tomorrow the market is not looking for any surprise tonight whatsoever.
Let's talk, Mike, a little bit about the defense sector and whether, in light of the president's new strategy that he will unveil tonight, there could be increased defense spending in the United States. And if so, would it be the aerospace companies, the drone makers? Where?
Ty, I think you put your finger on something. This is going to be with us. The president has already said that this is going to be a 3-year plan for him. It's going to be much more than that, and all of the sectors you just talked about will be longer-term beneficiaries of this. So I think the answer is yes, yes, and yes.
Mm-hmm. Let me ask you this. So this war is going to be a long war. That's what the president has said. 3 years, you're saying, or more. With that overhanging all of us, I mean, what are you, as an experienced investor, doing with your portfolio? Are you making any tweaks to it? Are you adjusting things to allow for this kind of long-term conflict?
Well, that's the right question for the viewers, Susie, because I learned just coming into the business many years ago that one of the most important things about investing is to survive, and to survive the bear markets. And the way to do that is when we are hitting the new highs as we are right now, given all these negative headlines, that one would look to take some off the table, and that's just what I'm doing myself. I've still got a very full equity portfolio, but I'm taking some chips off the table. And when in 2008, when things were very ugly, as Warren Buffett said, that's when you buy some things. So right now, I'm actually paring back. I'm not selling willy-nilly, but in fact, I've taken a few things off the table just in the last several days.
Okay. Thanks, Mike, for putting it all in perspective. Mike Holland with Holland and Company.